Imagine two companies launching on the very same day. They sell nearly identical products, charge similar prices, and compete for the same customers. Fast forward 20 years. One has become a Wall Street legend, rewarding investors with life-changing returns. The other has quietly disappeared, remembered only by former employees and forgotten headlines. What separated these two businesses? It wasn't luck. It wasn't flashy marketing, and surprisingly, it wasn't even having the best product. According to Warren Buffett, the answer is something almost invisible, a competitive moat. Most people look at a company and ask simple questions. Is revenue growing? Are profits increasing? Is the stock price climbing? Great investors ask something completely different. They want to know what protects this business from competition. Because if nothing stops competitors from copying a successful company, today's winner can easily become tomorrow's loser. But when a business builds powerful defenses, it can keep generating profits long after others have faded away. That's where extraordinary investments are born. Think about a medieval castle. The tallest walls in the world mean very little if an army can simply walk through the front gate. The real protection came from the moat surrounding the castle, making every attack expensive, risky, and often impossible. Businesses work exactly the same way. Their moats aren't filled with water. They're built from customer loyalty, powerful networks, trusted brands, efficient operations, and habits that competitors struggle to break. Investors who recognize those invisible defenses early often discover companies capable of compounding wealth for decades. Take Visa. Every time someone taps a card to buy coffee, groceries, or book a flight, a complex network quietly springs into action. Banks, merchants, consumers, and payment processors all rely on the same system. Here's what makes that remarkable. Every new customer who joins makes the network more valuable for everyone already using it. Every new merchant accepting Visa encourages more consumers to carry a Visa card. Every new consumer gives merchants another reason to keep accepting Visa. This creates what investors call a network effect. You don't need to remember the term, just remember the idea. The bigger the network becomes, the harder it is for anyone else to convince millions of people to leave it. Now think like an investor instead of a customer. Most shoppers simply see another payment card. Great investors see an invisible machine becoming stronger with every transaction. That changes everything. Instead of asking whether Visa will earn more money next quarter, they ask a far more important question. What could realistically replace a network trusted by millions of businesses across the world? The answer becomes surprisingly difficult, and that's exactly why investors are often willing to pay premium prices for businesses protected by powerful moats. Visa is only one example. Some of the strongest moats look completely different. Walk into a Costco warehouse and you won't find luxury displays or endless product choices. Instead, you'll see crowded aisles, bulk packaging, and shoppers who willingly pay an annual membership fee before buying anything. That sounds unusual until you understand what investors see. Every membership creates recurring income, while millions of loyal customers give Costco enormous bargaining power with suppliers. Lower purchasing costs become lower prices. Lower prices attract more members. More members increase buying power again. The cycle strengthens itself year after year, making it incredibly difficult for smaller competitors to match Costco without sacrificing profits. Apple built an equally powerful moat, but it doesn't begin with the iPhone itself. It begins the moment someone buys their first Apple device. Photos sync automatically. Messages appear across multiple screens. AirPods connect instantly. Watches, tablets, laptops, subscriptions, and cloud services work together almost effortlessly. Leaving that ecosystem suddenly feels inconvenient. Those hidden inconveniences are known as switching costs. Customers aren't trapped. They simply value what they would lose by moving somewhere else. Investors understand that businesses keeping customers happy while making departure difficult often enjoy years of dependable cash generation. Then there is Coca-Cola. Countless companies can manufacture soft drinks, yet very few command the same loyalty. Its greatest asset isn't the recipe. It's decades of trust built through memories, celebrations, advertising, and global recognition. That trust gives Coca-Cola pricing power. When ingredient costs rise, the company can often increase prices without losing many customers. Investors love businesses capable of protecting profits even when the economy becomes challenging, because predictable earnings usually create predictable long-term value. Amazon followed another path entirely. For years, critics complained the company wasn't maximizing profits. Jeff Bezos focused somewhere else. He kept reinvesting cash into warehouses, technology, logistics, and customer experience. Those investments created economies of scale. As Amazon handled more orders, delivering each package became cheaper and faster. Competitors faced enormous costs before reaching similar efficiency. Great investors recognized that temporary sacrifices were building permanent competitive advantages. Even impressive moats require maintenance. Netflix once dominated streaming almost alone. Eventually, major entertainment companies launched competing platforms, reclaiming their own content. Netflix responded by investing heavily in original programming, technology, and global expansion. The lesson for investors is simple. A moat is never permanent unless management continues strengthening it. Great businesses protect yesterday's success while preparing for tomorrow's competition. NVIDIA demonstrates this perfectly today. Its leadership extends beyond powerful chips. Developers worldwide build software using NVIDIA's tools, creating an ecosystem that competitors cannot easily replicate. Every additional developer makes the platform more valuable, reinforcing another powerful moat. Investors understand that ecosystems often outlast individual products. These advantages produce something every long-term investor seeks: high returns on capital and abundant free cash flow. In simple language, exceptional businesses earn more from every dollar invested while generating extra cash. They can reinvest, distribute to shareholders, or use to widen their moat even further. That's why Warren Buffett spends far more time studying businesses than predicting markets. Stock prices fluctuate daily. Extraordinary businesses create value for decades. Successful investors don't chase rising stock prices. They search patiently for companies whose competitive advantages become stronger with time. Once you begin viewing businesses through the lens of moats, you'll never analyze investments the same way again. The question is no longer, will this stock rise next month? It becomes, what protects this business for the next 20 years? Because in investing, extraordinary returns usually begin with extraordinary businesses. In the next video, we'll uncover why Apple became one of the most profitable companies in history, and how its competitive moat turned it into one of the greatest investments the world has ever seen.